Okay, cool. Yeah, we're live right now. So maybe we should introduce ourselves quickly. So Devin here, one of the co-founders of GammaSwap. Um, I do a lot of the BD and growth. And yeah, a little bit about me. Previously, what worked in crypto, so I was working for Figment. They do a lot of institutional staking. Met the GammaSwap team at a hackathon and thought what they were doing was really cool. So yeah, I've been building with the GammaSwap team for a couple of years now. And yeah, now we're live on Arbitrum base and Ethereum and just trying to help educate people on how to use the platform because it is a bit complicated. And for those who don't know, GammaSwap is the first perpetual options platform. So essentially, what we're doing is we're allowing people to borrow liquidity from AMMs. So it's a way to speculate on volatility with leverage on any token or to hedge your IL exposure as an AMM LP. I'll let Daniel introduce himself and then also talk about, yeah, why he created the protocol in the first place since it's his invention.
All right. Yes. So my name is Daniel. I used to work as a trader in Wall Street. I left the industry back in 2016 to dedicate to crypto full time. Was already trading my own strategies in cryptocurrencies back then. I've been in the space since like actively since well passively like a hobby since 2014, but actively like every day since 2016. In 2020, I was providing liquidity in Uniswap V2, and the X times Y equals K formula. Like I thought it was a genius, a good way to do this. Something that hadn't been done before, providing liquidity at any given price. So yeah, so the yields were pretty high back then, so it was a good time to be an LP. But then by the end of the year, early 2021, the yields were much lower. So I wanted to take the other side of the trade and to see also calculate the expected values. So what is the expected return of this? And it wasn't making sense anymore. So that's why I wanted to take the opposite side of the trade, but nobody was making that available. So yeah, so I figure if I borrow it and I'm essentially short the LP position. So I built a prototype of it, like a proof of concept. Seems like it worked. There were no technical difficulties about it. I mean, there were some questions still open, but seems like everything was something that could be solved. And yeah, so I started writing medium articles about it to see if there was something else that I was missing, and that's how kind of the ball got rolling into. But eventually got invited to a hackathon to show what I was working on from other people that were reading the medium articles, and yeah, and that's where I met the rest of the team. One of my co-founders, Roberto, and Devon was also there. Yeah, so and then we started working on it full time, and that was in May of 2022. So yeah, so it's we're live now. So and it looks like it's working exactly as I hoped it would work. Um, and yeah, so we're just excited to see how everything progresses.
Yeah, and since we are kind of this new thing and a bit complicated, big focus for us right now is just education on how to use GammaSwap properly, what it can be used for, and things like that. So, yeah, I know a lot of people are visual learners, me included, and figured live streams would be a good way to contribute to this education process. So today, we're going to be going over actually how to hedge impermanent loss with GammaSwap. It was something we talked a lot about early on and people were excited about. And now that we're live, people have had some questions on how exactly to do this. What are the risks, how it can be done, what you're actually hedging when you borrow a straddle in GammaSwap. So going to answer all those things today. So what we're going to do first is we're going to share the app right now and talk a little bit about yeah, what's available in the interface and those different positions, and then specifically straddle, what you're hedging, how you're hedging, things like that. So let me share my screen here. Okay. Yeah, it looks like that's up there. So yeah, what we have here is the trade page on GammaSwap. So this is the markets that are available. You can see the TVL for that specific pool, the open interest, so how much is being borrowed out essentially, and the borrow APR. And you can see the P&L of the straddle, basically based on your deposit, the historical price, the utilization, and the borrow APR. So yeah, and then there's 3 positions here. So a straddle, that is essentially what's happening when you're borrowing the LP position in a 50-50 ratio. So essentially you put up some collateral, and then depending on your leverage or LTV, you're borrowing a certain amount of LP, and then we're just splitting that LP into the V2 kind of 50-50 ratio. So GammaSwap only works with Uniswap V2 full style XMY equals K pools, but these straddles can be used to hedge other type of positions like Uniswap V3 LP positions. Today, though, for simplicity, we're just going to be going over how to hedge V2 pools because, yeah, we're still doing some math and some research on the best ways to hedge V3. And yeah, it can get complicated with the different ranges and the different ratios between the 2 tokens. So that'll be for a later date. But with the straddle, that's the 50-50. The long, we're rebalancing some of that collateral to the more volatile assets. So in this case, the wrapped EtherFi ETH token. So it's going to be 66% wrapped EtherFi and then 33% USDC based on the LTV. And then the short is the opposite. So it's going to be 66% USDC in this case and 33% wrapped EtherFi ETH. And when you essentially increase your leverage, your notional increases, and then you can see how your P&L changes. So you'll lose a bit more on the way down, but yeah, in terms of the direction you're choosing to trade with, that P&L will increase based on the price change. And then you can see essentially all these different values here. Your time to liquidation. So we're calculating a liquidation time based on your current LTV and the liquidation threshold, which is 99.5% on all pools. This can change unlike a liquidation price because if the borrow APR increases, that time will reduce. But these are all perpetual positions, so you can always keep adding collateral essentially to avoid liquidation. And there's no liquidation risk from price movement. Your current LTV, the opening cost for the positions, that's a combination of price impact and trading fees. You can see the breakdown by hovering over your delta. So straddle always starts out with 0 delta. The funding rate, so that's actually how much you're paying a day to hold your position relative to the deposit. And then your max price slippage that you're comfortable with, which you can change in the settings here. So yeah, that's essentially the trade page. So with the straddle here, what you're essentially hedging is the impermanent loss. So what you want to do is you want to match this notional position based on whatever your LP position is. And in the V2 pool, if those are the same, all of your impermanent loss will be hedged out. So you're still gonna have price risk with that hedge, but all of your IL will be hedged out. So it's going to look like a spot portfolio because typically when people talk about impermanent loss, they're talking about the loss compared to holding those, tokens in your wallet. So that's what you would be hedging here. So as you lower that leverage, maybe if you're looking for a long-term hedge, your time to liquidation increases, but your notional size will be smaller. So you might have to, deposit more to hedge the same amount of LP here. It's a little bit of a guessing game, but whatever your LP is, that would be it based on the LTV and deposit. And then we have some spreadsheets for this as well, which we've shared on Twitter and stuff, but we can share after the stream as well. So let me share this spreadsheet. Yeah, it's a little bit hard to see the numbers here, but essentially what you would do is for a straddle, you would put your, deposit that you're depositing as collateral, the LIUs that you get from that interface. You saw the dollars and then the LIUs. We use LIUs because it's a constant, so it's the product in the x times y equals k formula, and it's it helps with these calculations. The borrow APR, your entry price, let's say it's ETH USDC, that entry price there, the LP position you're trying to hedge, and then the supply PY. So you want to make sure that the dollar value of the LIUs and the LP position are matched to fully hedge the IL. Put the supply APY for the LP position, the borrow APR for the straddle, and then you can see your net APY. So let's say you have an LP position that's paying 50%, and then the borrow APR on the straddle is 3.4%. Well, the borrow APR for that pool is 3.4%. The funding is probably going to be higher. Then your net APY is 40%. To pay for that hedge essentially. And then you can see here that the net position, the IL hedge strategy is basically the same as the spot holdings, which if there's price movement is gonna have more value than the LP strategy. And then you're still collecting a yield from that. We can go into what it would actually be to be delta neutral, but just want to talk about the simpler use case, or just what you could use with GammaSwap, which is completely hedging out the IL. Take a second here. Is there anything else you want to add here, Daniel, on hedging the IL out?
Well, I guess the only thing I would say is that you can. It depends on what the borrow rate is. So it might make sense. It usually won't make sense to hedge with the same pool that you're LPing into. Like in our case right now, because we're giving out rewards on Arbitrum, it makes sense. Like the supply APY is higher than the borrow APR, for example. But there are other cases, for example, where like with USDC and Rapid 5 ETH USDC. See, the borrow APR on Wrapped ETH USDC is much lower than the borrow APR on Wrapped 5 ETH USDC. So that's an opportunity that's available there. I mean, you can hedge that. You can use that to hedge even on Univy2 right now, because I think the Univy2 yield is higher on mainnet, for example. So yes. So normally, so what this is trying to do essentially is that all Univy2 type of pools should have the same yield across all chains, all protocols, SushiSwap, Uniswap, because they're all now can be the impermanent loss risk can be hedged away in everywhere now. So I think the most common use case would be that you provide liquidity into a place like Rapid 5 ETH USDC and hedge out the impermanent loss from the price variability of Ethereum in another pool that's correlated with a Rapid 5 ETH USDC, such as Wrapped ETH USDC. I think that would be an adequate strategy for most cases.
Yeah, so like a barometer to see if a hedge is even profitable, Daniel, is just seeing if the borrow APR is less on the pool you're opening a straddle in than the pool you want to hedge. So that's a good just litmus test to see if it's even worth hedging, and then you can kind of look into the calculations further.
Right.
Yeah. Okay. So this might be something where normally if there aren't incentives in GammaSwap, there's going to be a spread. So that supply APY is typically going to be lower than the borrow APR. So we have incentives with escrow ARB right now, and we're going to have incentives with our own governance token. But in pools where that's not available, or at times maybe where those incentives might be lower, what you would be looking to do is seeing like how the APYs are being priced. So if there's any mispricing, you would come into GammaSwap when it's cheaper, hedge in GammaSwap, and then go somewhere else, maybe where the LP yields are really high, to collect that difference. So maybe it's something like Aerodrome or Trader Joe with a full range LP position, and just collecting that difference in yield essentially.
Yeah, that's right. And the whole thing is that since it's essentially risk free because you are doing an arbitrage, then the whole position can be funded through a loan. Yeah. So you can leverage that yield much higher. But I mean
Yeah.
that gets more complicated now. So I think that's probably beyond the scope right now.
Yeah, no, I actually have a spreadsheet for this. I mean, going through the calculations is probably going to be difficult on this call. I think we would need like an article or a thread on this. But essentially, so we mentioned how if you're using a straddle, you're hedging the IL, but you still have price risk, like you were holding, the assets in your wallet, right? So, you're holding 50% ETH. If ETH goes up, that's great. You're profiting, but if it goes down, you're losing out and you still have that delta risk. So you can hedge that delta risk just like you can hedge a spot exposure by using, a perpetual future where you could be getting paid funding for being short, or using a loan on something like Aave, Dolomite, or Silo, your favorite money market, wherever you think the rates are good or whatever your preference is, and hedge that out as well. So using a perpetual future, if you are LPing an ETH USDC pool and you want to be completely delta neutral, like this red line, this hedge strategy here, you could short your ETH exposure, um, since it's IL hedge, just directly the same amount of ETH you have in the LP. You short that using a perp. Maybe if you want to be very low risk for leverage, you do 1x, so it's the same. You could probably use 2 or 3x without worrying about liquidation price that much. And then if you use something higher like 10x, it's going to be very capital efficient. You're not it's not going to eat into your yield that much, but you might have liquidation price risk there, which you probably want to avoid, especially if you're hedging long term and don't want to actively manage this strategy every day. Or you can use something like a money market like Aave, where you would deposit the USDC a little bit more than you plan on having in the LP position for ETH because of the LTVs. Then you borrow some ETH and you'll actually get a liquidation price from that, which we're calculating in this spreadsheet for you. And then you would deposit that ETH with more USDC in the LP position. So it's essentially replicating having like single-sided USDC exposure. And then, you have basically a completely delta neutral position here, where you could, these are just based off some rates that we found on like Aave. But if you had like 50% of an LP position, a borrow APR, like 3 or 5% in the straddle, say it's 5% here. And then, the on Aave right now, I think USDC is paying like 7%. ETH costs about 2% to borrow. So if the LP position is paying 50% on a volatile pair like ETH or USDC, your total net APY from the strategy would be around 36%. So you're losing, I guess, about a little bit more than a quarter, somewhere between a quarter and a third of your yield, but you're completely delta neutral and have no IL risk doing this strategy. With something like a perp, that yield could probably be a bit higher depending on the rates, but it just depends what you're comfortable with. So this would be the strategy. I know some of these numbers are a little bit blurry, but you can see the chart here. The difference between the LP strategy in blue, the spot holdings in yellow, which is also what you would have if you LP and then use a straddle to hedge the IL, and then the strategy in red, which is the hedge strategy, which is using a straddle to hedge the IL, and then a money market or perp to fully hedge the delta. Yeah, I know this is a bit complex because you're basically managing kind of like 3 legs to fully hedge everything here. But we're going to be writing kind of more research threads and articles on this stuff, so you get a full understanding. And eventually, either us or hopefully other protocols or some mix of that can kind of build out these managed strategies, which would just be one click and manage all of this for you. So hopefully would make this, less difficult for the typical user to engage with. But if you're kind of savvy in DeFi and wanting to hedge some stuff out, and you're also, this is kind of the real yield API. There's also the implied APY from all these points programs that you have with GammaSwap or these other protocols. It's a good way to interact with a few protocols as well while being delta neutral. There's also strategies, which I think, here, let me share Twitter, but there's strategies where instead of trying to be, completely delta neutral, what you would do is you would try to be like long, essentially, long ETH or long Pendle with like earning a yield instead of paying a funding rate. So let me share my screen here.
Yeah, so I mean, I'll just add, if you try to hedge out all your risk, then of course you're going to get a lower yield because now you're not taking any risk, and that's where all the arbitrage comes from, because it's still a risk-free position, and it should be very low, like near the risk-free rate on treasuries, for example, like around 5% a year. But if you're willing to take some more risk, then you end up with a higher return. So that's what you have to try to figure out: how much risk are you comfortable with taking, and that's where your judgment comes into place also. Like if you think there's not going to be that much volatility, and maybe you just want to hedge out some of your risks to decrease the variability in your positions. When you decrease the variability, the advantage of that is that you can leverage more because there's less likely that you're going to encounter a liquidation situation when you decrease the variability of your returns. So yeah, so that's something, but I mean, that's up to your judgment on what you feel comfortable with.
Yeah, so I think it depends what you like, right? So if you want something that's delta neutral, maybe it's kind of a choppy market right now, you're uncertain, or you just want, a yield that's very predictable and not worrying about, any price risk. That's a strategy you can use. But of course, we're in crypto, we have biases, and we just want to collect a yield. So typically, when you're using a perpetual future, you can get a lot of leverage, but you're paying a funding rate to be long, which can eat into your yield, especially, when volatility increases and a lot of people want to be long. So I think the really interesting thing about using a money market to fund these positions is that you can essentially be long, 1 to 2x more if you're looping, but let's just say 1 to 2x to be safe here, and earn a yield, really high yield, instead of paying a funding rate. So if you want to basically have like a longer term view while having a directional bias on, let's say, something like ETH or Pendle, you can do that. And so, yeah, I'm sharing my screen here, sharing this tweet that Zero to Tom shared, because I think he has some really interesting, he's always sharing alpha on the timeline. And I think he understands DeFi really well. So here's a strategy he was kind of proposing, where essentially you would use some spot Pendle, going to Dolomite, depositing the Pendle, borrowing the USDC. So you're short USDC or long Pendle in this case, and then you would pair that with Pendle you already have in your wallet in like a Pendle USDC pool, and then you're earning all the supply fees from GammaSwap, ARB incentives, and then you're more than 1x long. And then at the time of this writing, you'd be earning 100% in APY for being long Pendle. So you get a little bit more leverage, but also you're accumulating yield and more Pendle through the supply fees over time. So it's a way to be long without paying a funding rate and instead collecting yield. So great, if you're looking at like having a directional bias in like the mid to long term. Yeah, you could also use same thing with the delta neutral thing. You can use a perp here. So instead of funding the money market, you could be long Pendle on a perp, and then accomplish this as well. But I think yeah, and then also depending on the LTVs here. So if the LTV isn't as tight, you're actually well, it depends on the money market. The LTVs are going to be a a little bit lower that you can open on these kind of like longer tail assets. But if you have that LTV closer to the max LTV, you're going to get a little bit more leverage. But yeah, you have same thing, like a riskier liquidation price. So just depending on your kind of like risk preferences is what you're comfortable with. So he kind of outlined it here at the 40% LTV. You could increase that if you wanted to, if you're willing to take a little bit more risk.
Yeah, the only thing I would say here is that he says you borrow USDC at 15.86% and then use half of your USDC to buy Pendle again. And so you can have your interest rate expense by just depositing enough Pendle to borrow the USDC that you need to deposit into the GammaSwap pool. So then you don't have to borrow USDC to buy Pendle again. So that's the only thing I would change here.
Okay, yeah, for sure. I think yeah, just a lot of these things depend on your risk preferences and what you're comfortable with. I think generally perps are a little bit more capital efficient than money markets, but money markets, I would say like, I mean, you probably know more than this on me, Daniel, but they typically use like blended oracles. So and liquidations can be slower. So even though your liquidation price might be closer with less leverage, it might be a little bit safer depending on the venue you're executing at. So it really just depends on what you're comfortable with. I think a lot of people, when they're looking at these strategies too, are willing to try them out with kind of newer protocols. I wouldn't call Dolomite a newer protocol, but protocols maybe they're pre-TGE because they're anticipating, you know, some extra incentives potentially using these protocols before their tokens are live. So all of these things are things, you know, you can consider with your strategies and execute accordingly. So yeah, we're going to be posting kind of more stuff like this, but it's always great when yeah, community members or people have identified these strategies too, because sometimes it opens our eyes to other things that could be possible. Yeah, depending on your strategy. And Pendle has been growing like really rapidly. Now they're, I think, like a top 5 TBL project in DeFi Llama. So yeah, if you continue to be bullish, this is a great way to express that and earn an APY. Okay, yeah, I think we're gonna try to keep these, I guess, short and sweet because we also want to post these on YouTube later for people to look at and use in their own strategies, or yeah, just help with education as well. So we're gonna kind of keep these live streams like pretty narrow in scope. So that's essentially how you would hedge the IL in GammaSwap using a straddle for a V2 pool, and then hedge a delta as well using something like Aave and a perp. And then yeah, we'll be going in more depth as well with kind of like written content. But yeah, this will help kind of like with the visual explanation of it. And